Welcome back to Yahoo Finance Live. I'm Jared Blikre. Didi stock up 30% off of the lows only a few weeks ago. And we're going to talk about it, all the actions from the PBOC to the local Beijing government, which may be taking over the company. And for that, we're going to bring in Brad Gastwirth. He is a Wedbush Securities Chief Technology Strategist. And Brad, when this stock debuted at IPO'd, I think it was only 2 days later that the Chinese government came out and just slammed it. And I think that sent a message to investors, but it's been popping recently. Can you tie this together? Is the worst over potentially as they look for their new owners, basically the state coming in and taking them over?
Yeah, Jared, you you hit it on the head. I mean, first of all, I think Beijing didn't really want Didi to become a public company trading here in the United States. And I think that by itself started the precedent of the perception, at least by Beijing, that Didi was not going to pay attention or listen or to adhere to sort of the structure that the government wanted. And I think right off the bat, there's a bad taste in the mouth by actually not necessarily taking their advice and still listing here. And to your point, I mean, the future holds a lot of interesting things, but clearly there's been reports that the Chinese government, is looking to get more investment into the company, and it wouldn't be surprising to see more involvement by the country.
And Brad, how do you handicap a potential delisting here? Is this something that is more than a 50% chance that it actually happens?
Yeah, and Brian, I mean, it's such a good question. It's hard to really put a probability on it. I'd say 50% just because it's a coin flip is probably the right way to assess. But yeah, I mean, I think with the rhetoric between the two nations really getting worse and worse, and I think when you look at what President Xi has been doing, he's been sending a message that look, he wants to take control back. Even though the government's always had control, there's been perception, at least from the U.S. investment community, that there was some autonomy in these companies, and that's really far-fetched. I think from the beginning, everybody had to understand that investing in Chinese companies listed abroad, they're still Chinese companies, and the government can do what they want. So I think that risk has been now more realized and known. And I think, is a delisting coming? That's a coin flip, but certainly it's a possibility, and it's maybe better than a 50%.
I'm wondering what you think this does for the EM space overall. You think emerging markets and lots of countries around the world. We used to talk about the BRICS, the Brazil, Russia, India, China, but you got to think that if you take an ETF like EEM, you look at the top spots, it's almost all Chinese tech. You got some other big giants in there like Samsung, but if you want to be an EM, how do you approach this now?
Yeah, and Jared, I mean, you're bringing up that. I think that's really one of the most important points here that I think people may be missing. And thanks for the question. I think in emerging markets, like the biggest country beneficiary here is probably India. You're having high growth, big population. And they also attract very strong talent on the technology side. So I think India is an interesting emerging market play. When you look at the indexes, I think indexes are tough because people really can put what they want in an index. That being said, for me, I like exposure to Southeast Asia. You're on port side, so you have access to water. Cambodia, Laos, Vietnam, Thailand, I think all those countries will benefit over time. Bear in mind the COVID situation is having a major impact in that region because the poorer countries are having harder times getting vaccinations. But I do like Southeast Asia. I see them as a net beneficiary. I think you'll see more going back into Latin America. As you sort of, or Jared, as you pointed out with the BRIC countries, it used to be talked about all the time, but I do think you're going to see more investment in Brazil. But ultimately, unfortunately, you'll see outflows continue for some time out of Chinese companies that are listed abroad. I think, these newer areas, and maybe Africa, but we're still a little bit too early in the frontier over there. I'd say those are the beneficiaries.
Is there one Chinese tech company that could survive this? Based on looking for one name that, maybe they have the best contacts in the Chinese government, whatever the reason, that is not in the same boat as Didi and their stock might thrive on the other side of this.
I think I don't think there's not going to be one company that's going to make it different than all the other Chinese listed companies. I think what ultimately may happen is you might see a shift going into the Shanghai or going in listed A shares. I think you might see that take place on these companies because if you look at what's happening in Hong Kong and even what China sort of did with Hong Kong, there's a lot of wild cards out here. But when I look at this world, and by the way, if you look at China, it's still an amazing open-ended growth opportunity. It's just I find it uninvestable from a U.S. perspective right now because you just don't know what that risk will be. So I'll wake up one morning and there could be more regulation, a delisting, something maybe being blocked. But I won't wake up one morning with a really positive thing from President Xi saying that he's giving control back to the companies. So I find the downside risk is very significant. The upside surprise is not there. And to me, that makes outflows likely for some time.
Yeah, you got to think that we're still in the beginning stages here and seeing all those stocks chopped in half and still basically in the bottom end of their trading ranges. We're going to be keeping an eye on this. And Brad, thanks for stopping by. Thanks for stopping by. Brad Gastwirth, the Wedbush Securities Chief Technology Strategist.
Welcome back to Yahoo Finance Live. Microsoft President Brad Smith out with an updated version of his best-selling book, Tools and Weapons, The Promise of Peril of the Digital Age Today. The paperback edition gives readers new insight into Microsoft's investigation of the SolarWinds hack in December of last year. Let's bring in Brad Smith himself for much more on the book. Brad, it's always good to talk to you. In the book, you describe the SolarWinds attack as a moment of reckoning, where you say that it illustrated the degree to which tech can be both a defensive and an offensive tool as well. What specifically was it about the nature of the attack that made you realize that, and ultimately what has that meant in terms of Microsoft's defense against some of these hacks?
Well, it was an attack that was extraordinarily sophisticated. It's been attributed by governments around the world at this point to the Russian Foreign Intelligence Agency. And what it specifically did is it infiltrated the software supply chain of a particular company, in this case SolarWinds. And then by installing malware in one of that company's updates, it reached tens of thousands, roughly 17,000 companies around the world. And it was in many ways, I think, an act of recklessness in terms of the form of the attack. And we just have not seen something like that impact successfully so many major governments and tech companies before. And so it's been, I think, as events have had it, as we spell out in our book, a galvanizing moment, not just for the tech sector, but for the White House and for governments around the world, rightly so.
You've already committed to spend $20 billion over the next 5 years to build up defenses for cybersecurity. I know you've been working closely with the Defense Department, with the Biden administration. As we see the nature of these attacks step up, what do you see as the role of the private sector as well as the government in trying to wage against these attacks that feel like they're really elevating on a weekly basis in terms of the nature of them?
I think for those of us in the private sector and in the business community, there are three really important roles. The first is for the tech sector itself. It's for companies like Microsoft and others to strengthen our defenses, to strengthen security protection, to expand security services. I think the second is really across the economy and across the private sector, and that's basically to put these protections to work. Every organization, whether it's a nonprofit, a government, or a business, is going to need to up its own protection. And in some cases, that just means using what it has already purchased. In some cases, it may mean more. And then finally, I think there's a broad cybersecurity skilling challenge. It's a challenge because there's a shortage across the country and around the world. It's a challenge for the education community, for community colleges, for services like LinkedIn that Microsoft operates. But ultimately, it's a challenge we all need to meet We're all going to invest. We're all going to need to invest in more skilling and then more hiring of cybersecurity professionals.
Yeah, and I guess that's kind of the tricky part in putting this all together, right? Because, the SolarWinds attack seemed like it had been going on a lot longer than people realized. And, $20 billion seems like a lot of money, but when it's spread out over 5 years coming from just Microsoft, obviously it's going to take a big partnership here in private and public. But $150 million to help the U.S. government update and protect their own kind of systems as well. I mean, but what more push do you think needs to happen maybe here from the government, given the fact that we are seeing a lot of these attacks rise from Russia and other countries, the concentration there? What's it maybe going to take more in protecting Americans and American companies, maybe on the public side?
Well, I think you make a great point, and it's really a lot of what inspired my co-author Carol Ann Browne and I to add more material to this book and this particular chapter. It starts with a better understanding of the problem. And that requires that more companies and others share more information broadly with each other. In some ways, I think it's even appropriate to use this week, the 20th anniversary of 9/11, to reflect on one of the lessons of the 9/11 Commission. It was a failure of intelligence, sparked in many ways by a culture where people only had a way of sharing knowledge, information, when they felt there was a need to know. And the 9/11 Commission said that needed to shift to a need to share. That is something for all of us. I do think it will require some acts of Congress. That's another part of the story in the book, how this went from the tech sector to the White House to the Senate Intelligence Committee. We're going to need laws that I think mandate information reporting to the right part of the government at the right time in the right way. And then I think it is a whole of society moment. And that was really the watershed, I think, that we saw at the White House last month, bringing together not just tech companies, but community college leaders, energy company CEOs, insurance and banking executives. We all are going to need to take new steps. And as you put it, we need to do it together.
Brad, one of the other things that you've been exploring throughout the pandemic really is about the access to broadband, something that you had pushed pre-pandemic, but we really did see this divide, especially with more and more people at home with remote work. As a company, how have you been thinking about your role in trying to expand access to internet? Obviously, Microsoft employees largely in areas where it's readily available, but it feels like that conversation was there at the beginning of the pandemic. Now it's kind of taken a step back.
Well, the first thing I would say is I'm reluctant to say that anything as terrible as a pandemic has a silver lining. But one thing that COVID-19 did do is caused us all to see something that was in front of our eyes to which we weren't paying enough attention. And that's the broadband divide. That's why we've been banging this drum for several years, saying, look, broadband's the electricity of the 21st century, and the people who don't have it are basically living in the 1990s. The good news, in my opinion, is we are awakened as a society, really as a planet. We're seeing major commitments by the administration and Congress, including in the infrastructure bill, to take the kinds of steps that will be needed to close this gap. Certainly for Microsoft, we have multiple roles. It starts, frankly, with just great data analysis. We've provided what I think is now regarded as the preeminent map of the United States in terms of just enabling people to see who has broadband and who does not. But knowledge is just the beginning. I think there are new partnerships with new technologies. With a company like SpaceX, we can look forward to, I think, a brighter future with low Earth orbiting satellites, with more partnerships with telecommunications companies. We have the wherewithal as a country to solve this problem in the next 4 years. And I would almost say shame on us if we fail to do it, because we're going to be leaving too many people behind in rural America, and especially underprivileged and racially diverse communities in urban America. And I just don't think our country can afford that.
Yeah, and I mean, as you talk about that gap, there's also the gap in terms of hybrid work in this pandemic that's been pretty evident as well. That's increased the role of platforms like Microsoft Teams. We've talked about Slack getting used as more people are working outside the office. I mean, how quickly does that side of the business become even more important the longer this drags on? And maybe, if we never get back to the idea of a full return to normal and hybrid sticking around, I mean, talk to me about the growth that you've seen there.
Well, we obviously have seen tremendous growth since the pandemic started in March of 2020. In many ways, we've seen services like Teams explode. We've seen broadband usage double in the course of a couple of months in 2020. And I think there are many aspects of this that will be here to stay. Perhaps not everything in every way. One of the things we talk about in one of the new chapters in our book is really how we can learn from World War II and what persisted and what abated after the war ended. I think the encouraging word is really to recognize that there is a blended future that creates more opportunities and more flexibility, probably for all of us. And it's not just working from home, but that is one important aspect. It's the opportunity to consult with a doctor via a telehealth service rather than having to trek to a physical office every time you want that kind of consultation. It's the opportunity for a sick child to attend school from home with a broadband connection, or for people to stay connected during a snow day. So I think we're going to have a future that basically puts, think of video, interactive video, next to what we all grew up with the telephone. We could go visit family and friends, or we could call them on the phone, and our experiences were better because of it. Now we have video that opens the door to much richer interaction like we're having with this conversation, but now it's open to everybody, including in meetings with their employer and their team.
Brad, I'm curious to get your thoughts on what is playing out in China right now, because Microsoft's Word, Excel, PowerPoint recently named among a group of apps that have been accused of misleading or infringing on user privacy. And I know you had a conversation recently with an official at one of the regulators over in China. What have you gleaned from that conversation, from conversations you've had about the intention of the most recent crackdown? And ultimately, what does it mean about the way in which Microsoft operates in the country? It is one of very few tech companies that have a big presence there.
Yeah, and I was able to meet last week with the Chinese Minister for Industry and Information Technologies. They put out a statement after the meeting. I would say two things. One is, there is, in my view, the real need for clarity and stability in the broader technology relationship between China and the United States. I think part of that needs to come from China. Part of it needs to come from Washington, D.C. Clearly, there are going to be guardrails, and we need guideposts. So there's a mutual understanding of where the two governments want to see American technology companies play a role. Our view is that services like Word and Windows and productivity and the like have an appropriate role to play on a global basis. And there are other services we have, say like facial recognition and certain AI services, where I don't think either the Chinese or US governments are going to want us to necessarily be involved. I think that there is a real need for conversation about how we can play a role, how we need to play a role in China, so that American multinationals that have presences in China can use our cloud there just like they use it everywhere else. And I think there's an urgent need to talk about how we can put technology to work globally, including in China, to help reduce carbon emissions, and how we ensure that a global basic research community that operates in certain scientific fields can, and in an appropriate way should, use common technology. But we need to get to specifics. You can see from my list, having broad conceptual conversations, which is natural in the new administration, is the right place to start. But as we look to 2022 and the second year of the administration, it will be time to go from generalities, principles, and dive into specifics.
Well, we hope to keep the conversation going with you, Brad. Always good to have you on the show. Brad Smith, president of Microsoft, joining us on his new updated book. Thanks so much for joining us today.
We all know home delivery has thrived during the pandemic, but alcohol delivery in particular has skyrocketed. Just ask Minibar Delivery, where business is up nearly 140%. The alcohol delivery service just aimed to deal with its very first retail partner, 7-Eleven, And here to talk about it now is Minibar Delivery CEO, Lindsey Andrews. Lindsey, good to see you. Before we get into that partnership with 7-Eleven, I just want to talk about the pure numbers you're seeing. I know at the height of the pandemic, you saw a 500% increase in new customers. Talk to me about whether you've been able to retain those customers, and what are those numbers like 18 months into the pandemic?
Yes, thank you so much for having us. In the height of the pandemic, we saw new buyer growth over 500% as everyone was sheltering in place and they wanted all their food and alcohol delivered to their homes so they could stay safe. With vaccinations and the nice weather of the summer, we definitely saw kind of some of those astronomical numbers come a little bit down to earth, but we've seen an uptick in sales more recently with the unfortunate resurgence of the Delta variant. So we've continued to grow and hopefully help people stay safe and stay home with our great liquor store partners so they can deliver the alcohol to everyone's doorstep.
So it's interesting, it's sort of, so as goes the virus, so goes sales. I mean, did you see that when things were opening up and things seemed a little bit more positive early in the summer, did sales perhaps not dip, but maybe come off those highs that you had seen recently?
They did. So they were still, way up from 2019, but we did see a little bit of a softening, June, July, August, as the nice weather and the vaccinations and, people had pent up demand. They had been sitting at home, cooped up for 15 plus months. So it was natural that they kind of wanted to get out. But we've continued to see really strong growth. Most notably, stores still really anxious and excited to get on our platform. We've seen our store network grow by 170% in the past 12 months, which has been really exciting, most notably with the addition of 7-Eleven in the past couple of weeks, which we've been really thrilled with.
Yeah, so talk to me a little bit about that partnership and why was 7-Eleven and that branding right for your company?
Yeah, 7-Eleven obviously is an amazing national and international brand. We are thrilled to partner with them. They sell beer in, thousands of their locations. They sell wine in a selection of their locations, and they even sell hard liquor in some of their locations in California. So our initial launch with them was about 600 stores in Florida, Texas, and Virginia. And we're really excited to continue to add stores throughout the US. The next states will be New York and California. And it has tons of other benefits for us too. We added a new category for snacks and more. So you can get a Slurpee, you can get ice cream with your, 6-pack delivered all to your door in under an hour. Also in Texas, where liquor stores are closed on Sundays, 7-Elevens are actually open. So now our consumers in Texas can order beer and snacks and more on Sundays for easy and quick delivery, which has been great. And obviously we are thrilled to work with such an amazing brand like 7-Eleven.
Yeah, there's a loophole for you in the state of Texas. Talk to me about what is in demand right now. And I'm curious sort of what you see trending among alcohol and spirits. And has that changed at different points during the pandemic?
It has. So, spirits, that category has done extremely well for us in the pandemic. It used to be about 30% of our business, and now it's over 40% of our business, kind of through the pandemic. So I think people, much like the cooking craze, I think people really got into cocktail making since they could no longer go to a restaurant and have a cocktail made. So I think people were experimenting with that. So we saw a great uptick there. And then maybe people got a little tired of making their own cocktails because then we saw ready to drink go up a ton this summer. It was up 145% versus last summer. So I think people, it's a newish category, the ready to drink cocktails in a can have done really well and have kind of overtaken a lot of the beer category and liquor category. So that's been really interesting to see, as it's kind of much like hard seltzer was kind of a brand new category a year or two ago. Right. It seems like the ready to drink category is that new fun thing people are trying, and it's growing extremely fast.
Is wine outpacing beer? I'm always curious about that one.
Yes, on our platform, wine very much outpaces beer. I think our consumer, we split pretty equally male, female. It's a fairly urban demographic, and we do see wine does really well. And it's an item that people replenish frequently. So we have seen wine. It's the vast majority of our sales, unlike beer, though with our partnership with 7-Eleven, I think beer is going to, start to do and catch up to the wine and spirits soon.
Yeah, I think you're right on that one. So look, there's a lot of uncertainty surrounding the holidays with this Delta variant. Now, what are your expectations for holiday sales? Because a lot of those big parties may not be happening. And any idea what might be in demand for the holidays?
Yeah, so it's interesting. I feel like last December, we had no idea what to expect because a huge part of our December business is holiday parties and corporate parties. Obviously, none of those things were happening last December, so we're kind of bracing for a softer month. But it ended up being huge. I think people were sending tons of gifts. We had launched gift cards, which did tremendously well. People sending that to their friends and family or to their coworkers. So we really did see a normal, typical December in terms of overall orders and sales volume. The one thing that didn't grow as much as in past years was our average order size, because we instead got lots more orders, but they were smaller since people weren't having parties. So I expect much the same this December. Tons of people sending friends and family gifts that maybe they can't see. Corporate customers sending the gift cards to their teammates. Maybe they're having Zoom holiday parties. But I do expect, the parties and corporate parties not to be fully back, especially as so many of the big companies have pushed their back to office dates to January 2022.
Right. Makes sense. And real quick here, Lindsey, I know that since 2014, you've raised something like $7 million at Minibar Delivery. Are you doing another round right now? And are you looking ahead to bringing your company to the public market?
Great question. We are not currently fundraising. We're actually been profitable through the pandemic, which is, I feel like, unusual for an early stage startup. We're a very lean, mean team. And while obviously this is one of the biggest IPO years ever, we are not currently looking to IPO in the next couple of months, but who knows what the future holds. We're really excited and bullish on this category.
All right, well, come back when you do. CEO Lindsey Andrews of Minibar Delivery, or come back even if you don't. It's been a great chat. Thanks so much.
I think Brian Sozzi put it well yesterday when he said, we're in a weird place in the markets, in where we're trying to figure out where the economy is going. Is that okay if I quote you, Brian Sozzi?
I love it. Go write the article too.
Excellent.
Please get it out there.
So I want to bring in someone else to give her perspective on this, and that's Erin Browne. She is a portfolio manager at PIMCO. Erin, it's good to see you again. And I think Brian said that, if I can paraphrase him, because we are looking at the Delta variant and its effect on the economy. We hear the ECB today saying they're going to be shrinking their bond purchases as we await similar news from the Fed. We've got a lot of forecasts out from Wall Street strategists, and there's a pretty wide range in what they're expecting. So when you look at these markets, how do you put all that together and figure out how to trade it?
I think we're in a transition spot right now in the economy, as well as in broader markets, where we're transitioning from a very early cycle environment in which growth was supercharged coming out of the recession of last year, and in which markets were really, driven by beta coming out of this very early cycle environment. And now, as we start to move into more of a mid-cycle environment, it does get a little bit trickier. We do expect that returns are going to be lower, certainly than what we've seen over the last 12 months or so, but we're still in a very good spot in the economy. And I think we're still in a good spot in terms of corporate profitability and the outlook for it. So while I think you're going to see less supercharged moves to the upside, I do think you're going to see a more gradual continued appreciation of the market, albeit with a little bit higher volatility.
Erin, perhaps you could break this down for us. So you have the ECB now saying it will scale back its bond buying. Potentially the Fed could be in the same position before year end. Those are two powerful developments that have not been the norm in markets. What do you think will be the impact to bond and equity markets as these two things are happening at the same time?
So listening to the ECB today, I think it was really key. Firstly, it was largely in line with expectations in terms of their announcement of a gradual tapering of the PEP program. But I think what was important was that it's going to be modest, and they're still likely to remain engaged in buying for a very long time. And that's going to continue to support risk asset markets. In addition to that, it looks like they're going to be behind the Fed, certainly, as well as the Bank of England in terms of rate hikes. Right now, the market's not pricing in anything in terms of rate hikes until December 2023. And even at that, it's about 10 basis points. So a very gradual return to more normal markets with respect to the ECB's bond buying program. Similarly with the Fed, while the Fed is likely at the upcoming meeting to pre-announce the announcement of the start of tapering, they're likely going to do so only very gradually. And we're not anticipating that they're actually going to start tapering until January of next year. And with that, we expect it's going to take at least 6 to 9 months for them to end their bond buying program, after which we expect that in the midpoint of 2023, they'll start raising rates for the first time. So again, we're going to be in this prolonged period of central bank involvement on a global basis, and that's going to be continually supportive for risk assets. Keep in mind, real rates in the US are still about -1%. That's a very, very benign environment for risk assets.
And maybe a benign environment or a conducive environment for inflation to continue to grow too, Erin. On a micro basis, at least, we're hearing so many companies still talk about raising prices and talk about supply shortages. Could we be in a more sustained, even 3% inflation world? And what effect is that going to have on equities?
Yeah, it's a great question. And the question whether or not inflation is transitory is something that, certainly is central to the market conversation right now. We still believe that inflation is transitory. And if you dig in and look at what the predominant drivers of inflation have been over the last 6 to 12 months, it's largely been driven by these one-off price increases, which once they sort of settle are likely not to persist, where we'll continue to see increased prices over time. So as an example, one of the predominant drivers of inflation over the last, at least year to date, has been new and used car prices. And that's because, as you noted, it's been very difficult to source some of the raw materials that go into cars, and particularly to source semiconductor chips from Asia, largely because of supply chain shortages being driven by the pandemic. That is something that we would see as a one-off price increase. But we don't expect that you're going to see an upward spiral of continued price increases, particularly as supply chains normalize coming out of the recession. So we do expect that inflation will remain high this year in the mid 4% at year end, but will likely decrease to about 2.3% at year end 2022. And so we are going to see a more normalized inflation environment, particularly as we move through the back half of next year. And so we do think that the Fed is viewing these price increases as transitory and likely won't react too aggressively in response to what they see as a transitory impact.
Have you made any changes to your portfolios this month so far?
This month, we've been gradually starting to look at some of the more industrial sectors, some of the more cyclical sectors in the economy that have underperformed over the last 3 months or so, but we think are likely to start performing well, particularly as we exit this heightened period of concern regarding the Delta variant. So both on the industrial side as well as on the leisure and hospitality side, we do think that you will see more normalization, and that's likely to augur well for some of the more cyclical sectors. We had transitioned our portfolio to a much more defensive orientation about 3 months ago, buying the tech sector again, which turned out to be well timed. But we think now we're going to see, particularly into the fourth quarter push, a return to more cyclicality in portfolios.
Interesting. Erin, it's good to see you. Erin Browne is a portfolio manager at PIMCO. Thanks for being up bright and early for us this morning. Although I know you're up anyway, but still, on camera is a different animal. Thanks so much, Erin. Appreciate it.
Shift our attention to the game now with one of the NFL greats. We've got Joe Theismann. He is former NFL MVP as well as Super Bowl champion. Joe, we should point out it is your birthday today. So let's start by wishing you a happy birthday. A good way to kick off, right? A good way to celebrate here.
What a great
season.
What a great birthday present to have the NFL season kick off tonight with the Cowboys and the Bucks. And also, I might add this, it's my son Joe's birthday as well. So we share a birthday together, and it's exciting, it's fun, and it's exciting to be able to sit and watch football tonight. We've heard so much rhetoric about so many different aspects of life and the games. Now we're going to get a chance to really watch some football, which is going to be exciting and fun.
Yeah, I mean, celebrations all around here, but something tells me that you've got a big favorite in this Cowboys and Bucks matchup. How do you see this playing out?
Well, I think Tampa Bay's defense is just one of the best in the league. And you know, I hope Dak is healthy. I hope he gets through everything healthy. But I've tried to recover from a broken leg, and I had shoulder problems, and he hasn't had a lot of practice time. I really feel like the key to this football game tonight is the offensive line of the Dallas Cowboys and Ezekiel Elliott's ability to run the football against Tampa Bay so that Dak doesn't have to drop back 50, 55 times. But, you know, and of course, how can you not root for Tom Brady one more time? It's funny, with all the success that Tom has had, there are those people out there that just say they're so sick and tired of seeing Tom at the top of the mountain and Tom at the top of his game and all this other stuff. My whole feeling about that is if you don't want him there, knock him off the pedestal. And no one's been able to do it. So he sits atop of our league as, I think, the best player in the league, the best quarterback certainly of all time. And it'll be fun to watch him in his 44th year. I don't believe he's from this earth, to be perfectly honest with you. I think he's been beamed down here just to give us an idea of what might be where SpaceX is going and everything else. So there might be something else out there. There might be more Tom Brady somewhere out there. I'm not sure.
Yeah, I hope nobody knocks him off from that shelf. He's on my fantasy team this year, so fingers crossed. But Joe, I mean, I know you've been busy. You've been working with medical cost company MedLiminal. We talked about them last time, and it is kind of at the heart of one of the issues. Obviously, the NFL has been pretty strict about vaccines for players and trying to control that. You know well, through working with them, I'm sure, the costs associated with COVID. So, I mean, how are you looking at maybe how the NFL has pushed that? You mentioned Dak. He's been kind of at the forefront of not wanting to really reveal much about his vaccine status. I mean, what's your take maybe on how it could be a liability for some teams out there?
I think there's a possibility it could. COVID certainly looms as a big cloud over the NFL. You're not going to be sure exactly what's going to happen to teams. It'll certainly affect the betting, which we were talking about before, about how many sponsors now have jumped in. I think one of the things the NFL did last year during the pandemic was they increased the practice squad to 16 players, and they have what's basically a PUP rule, which is PUP. If you're allowed to bring players up to your team if somebody's not available twice, but the second time they come up, they have to remain on the roster, so you'd have to release someone else. So they created some flexibility in this rule and gave you a pool of players to be able to bring people in so that the quality of the game can remain the same. And that's a big thing. I think You'd hate to see somebody lose 3 defensive backs and then all of a sudden try and play a team that throws the ball around 40 or 50 times. You know, you're going to play the Kansas City Chiefs and all of a sudden you've lost 3 defensive backs. It would certainly be a challenge. So in an effort to remain with parity, in an effort to try and keep the playing field as level as possible, I think the NFL made a very wise decision, and it's carried over into this year as well. And so that's from a medical standpoint. And you're right, I've been involved with MedLiminal now for over 3 years. And what we basically do is we look at businesses and we look at the expenses that they have regarding healthcare, and we try and help them manage through it, because there isn't anybody out here, I believe, that's listening, maybe a doctor or somebody in the medical profession itself can understand what is on a medical bill. And this is what MedLiminal does. And it's very easily spelled. It's MEDLIMINAL, and you can go to medliminal.com and look at what we do. And we basically, look for inaccuracies in the medical bills and make sure that you're paying what you're supposed to be paying.
To what extent, though, Joe, working with these companies, have you seen the investments shift as well as the attention to medical care? I mean, we've talked so much about the benefits and the priorities being shifted as a result of the pandemic. What specifically have you seen from the business side?
Well, some of what you've been able to do is if you can, costs are always very important when you look at a company. What are they spending on healthcare? What are they spending on advertising? What are they spending on marketing? You look at these costs, and the area of healthcare is one where if you have someone that can look at a bill and say, well, this isn't quite as accurate as it should be. There is a percentage here that you're losing because of the inaccuracies of the bill itself. It's a chance to be able to recoup some money. And so obviously there isn't a company out there that doesn't want to try and save money. And in this environment where we're now finally starting to see the workforce increase because of the payments from the government stopping, so people basically have to go back to work. So you're going to have more people out there working. You're going to need more eyes on it. So, I guess you could consider MedLiminal like a big brother, sort of looking over your shoulder, making sure that this is one aspect that we can handle from a business standpoint that can save you money.
Yeah, and out of all those companies out there who have been nervous about losing more money, it's kind of explains why the NFL has been pushing its players to get vaccinated and really stepping up the penalties there because they don't want to see money lost on those games. But Joe, I mean, to turn back to the game itself here, and particularly some news about your Washington football team there, as a Washington great. We got the list of names here. There's about 8, they say, that it's whittled down to. You got Armada Presidents, Brigade, Red Hawks, Commanders, Red Wolves, Defenders, and of course, Washington football team still. You're the greatest Washington player I think I can ever remember here. So talk to me about which one you'd throw your support behind.
You're very kind. You realize this is a political environment, and I live in the Washington, D.C. area. So I have to play politics here a little bit. I really don't know what the name is going to be. I have no preference. That's above my pay grade when it comes to the decision. I would like the decision made as quickly as they possibly can. And keeping in mind, just as an example, it took the Rams 2 years to be able to get their logo approved on their helmet. So how much goes into securing a name? How much goes into changing a name? All the things you have to be conscious of, the suits that might possibly come. These are all things that the team has to go through that fans don't understand. They just think it's a light switch. We want a name, let's flip a name, let's put it on. There's a lot more to it. And so from my perspective, whatever we become, I think that this young group of football players on the Washington football team will have a chance to establish their own legacy going forward under whatever name or whatever logo they're going to have. But it's an exciting young group, one of the youngest teams in football, led by one of the oldest quarterbacks in football. I think next to Tom, Fitz is right up there with Ben and a few of the others. Of course, this being the 9th of September and Fitz is in the 9th team that he's on, maybe it's just an omen that this is going to be a special year for Washington.
And finally, Joe, we have to put you on the hot seat before we let you go. 5 months out from the Super Bowl, never too early to start talking about it. What's the pick? What's your pick?
Oh, goodness. I've avoided this question 5 times already today. Not to mention everybody that's wished me happy birthday and said, oh, by the way, who do you think is going to be in the Super Bowl? I still believe that the Tampa Bay Buccaneers defensively dominate. I believe defense wins championships. So I wouldn't count out the Green Bay Packers. They've been knocking on the door twice. I still like Tampa Bay. And on the AFC side, I just think it's the Buffalo Bills' time to be able to rise to the occasion. Once again, I will qualify my predictions with, we don't know what COVID will do to teams, and we don't know what injuries will do to teams down the stretch. But right now, I'm looking at Tampa Bay and Buffalo, and everybody else, don't get mad at me. It's just something early in the season.
You're going to start getting calls, but you're right. COVID, the big unknown. I mean, Tom Brady at 44 years old. I think at that point, even those who have not supported him throughout his career, they'd be rooting for him too. But Joe, it's always good to talk to you. Hope to have you back on the show again soon.
Thanks, everybody. I appreciate it. And thank you for the birthday.
Happy birthday.
Thank you.
Rocket Companies has gotten into the red-hot market for vehicle buying, launching online marketplace Rocket Auto. Let's dive in here with Rocket Companies Vice Chairman and CEO Jay Farner. Jay, good to see you again here. So what brings you into the auto market game?
Yeah, good morning, and thanks for having me. We're super excited about Rocket Auto. Remember, as the largest mortgage lender in the country, we have the opportunity to speak to millions of clients a month about their finances. And one of the things that we found is that once people are refinancing their home or thinking about getting a mortgage, they're 2 or 3 times more likely to be buying an automobile. And so it makes perfect sense to offer a marketplace where we can help our clients find those automobiles. And we're already selling thousands of cars a week with Rocket Auto.
Hey, Jay, it's Julie here. To be clear, you guys don't offer auto loans, right? So I have to cop to being a little confused by this offering, because it does seem like, are you planning to go into auto loans? It seems like it's sort of in a different direction for you guys.
Well, look, our premise is that we remove friction in complicated transactions. 2.5 million clients right now pay their mortgage to Rocket Mortgage, and we've helped them with real estate and mortgage for over 26 years. But one of those other complicated transactions is the purchase of an automobile. And so we already know our clients, we know their credit, we know their income, we know the type of cars that they like. And so to partner with over 300 dealerships across the country and find the right car for them and remove the friction is really our mission. And then, of course, you've just mentioned financing. We've got our Rocket Loans business, and that's really a great streamlined white labeled business, or the opportunity to be white labeled. And so we can use that technology, that underwriting technology, for things like solar loans, personal loans, and of course, maybe in the future, auto loans. So making sure that we can differentiate ourselves by creating this marketplace and streamlining the experience was our first step. And then who knows where we can take it from here.
So, Jay, it's Brian Chung here. It sounds like there's kind of this ecosystem that you're building over there at Rocket Companies then in that case. So I guess right now is this kind of introductory marketplace a way to kind of aggregate data on the types of customers that you have to offer them other types of products that might be helpful? And I guess the next natural question is, why not just get a bank charter, I guess, at some point, given how many places, I guess, you're in when it comes to the financial services space?
Yeah, that's a great question, and you're thinking about it exactly right. This is truly an ecosystem. We have this opportunity where we speak to clients day in and day out about the most complicated part of living in many cases, which is home ownership. And so we build great trust there, as you're aware of our J.D. Power Awards year in and year out. And so how do we grow that ecosystem? And we've done that with personal lending. We've done that with real estate. We're doing that with auto. We've announced solar as well, and we'll continue to do that. Now, when I think about banking, I actually kind of think the other way as we watch DeFi and all of the exciting things that are happening in that space. I wonder where banking is going. And I think of Rocket as a brand that people trust. I think of us as a cloud force, a Salesforce, a technology platform, great marketing. And how can we leverage those things to help remove the friction? I think banking will continue to shift and change, and we're uniquely positioned to be that business that sits between a client and their needs and providing the service. But I think we'll watch and see where the future is headed. Traditional banking may not be the right path, at least for us.
Jay, speaking of friction, the housing shortage, it continues in this country. It gets worse. Do you see any ending in sight, and why is this happening?
Well, we've had incredibly low interest rates. We've had a shift as people think about their work-life balance and spending more time at home. And so we've seen great demand in the purchase market. In fact, we had our best quarter ever in Q2. We're set to become the largest purchase lender in the country in the next 24 months. And so we don't see that demand ending anytime soon. We do see inventory getting a little bit better. July was a bit better. And we're also launching a variety of programs with Rocket Homes, our real estate arm, to help our clients have access to more inventory. So, I think inventory will continue to increase slightly as we get into the fourth quarter, into Q1. That'll make things a bit better for purchase, but purchase demand is going to remain strong here as we get into 2022.
Jay, I'm switching gears for a moment. Apologies. I want to ask you about some news of day, which is President Biden's announcement last night that the federal government is going to seek to mandate that companies with over 100 employees require their employees to be vaccinated. And that just spurring me to ask different CEOs. We're going to ask everybody today what they're doing on the vaccination front. I know you guys have a few more than 100 employees. So what is your current policy, and does it have to change?
Well, we've been very fortunate. We've got over 26,000 team members across the United States, many here in Detroit, Michigan, and they have been incredible over the last 18 months or so, really getting everybody working from home the minute the pandemic started and continuing to grow our business. As you know, we had our largest year ever in 2020, and we're looking to have even a bigger year in 2021. And what we've learned is that we can perform in an excellent manner, regardless of what's happening, whether people are working from home or working in the office. Now, for us in our culture, we want people in the office as much as possible, It encourages collaboration. And so we already rolled out a process very similar to what President Biden has asked for a few weeks ago. So our team members are either vaccinated or testing weekly before they come in the office. So we're kind of ahead of the curve and people are accustomed to that. And so we'll continue to have people in and out of the office to make sure that we're supporting our culture, but also keeping people safe. And it's working great. So for us, kind of steady as she goes based on where we've already been this summer.
Good to hear it. Rocket Company's Vice Chairman and CEO Jay Farner, always good to see you. Have a great weekend.
You bet. Thanks for having me.